Today we are covering international economics for the Series 65 exam, specifically focusing on trade deficits, currency exchange rates, and the balance of payments. The exam will test your understanding of how these global factors affect domestic markets. You'll likely see questions that present a scenario, such as a strengthening US dollar, and ask you to identify the impact on U.S. exports and imports. A common trap is confusing the impact on exporters versus importers. When the U.S. dollar strengthens, it means it can buy more of a foreign currency. This is beneficial for U.S. importers because foreign goods become cheaper. However, it is detrimental to U.S. exporters because their products become more expensive for foreign buyers, potentially leading to fewer exports. A persistent excess of imports over exports results in a trade deficit. On the exam, you must know that a strong dollar contributes to a trade deficit because it encourages imports and discourages exports. Conversely, a weak dollar makes U.S. goods cheaper for foreign consumers, which increases exports, and makes foreign goods more expensive for U.S. consumers, which decreases imports. A weak dollar, therefore, tends to reduce a trade deficit or create a trade surplus. The balance of payments is a broader measure that records all economic transactions between a country and the rest of the world. For the Series 65, think of it like a country's financial statement. It's composed of two main accounts, the current account and the capital account. The current account primarily tracks the trade in goods and services, what we call the balance of trade. A trade deficit is a negative balance of trade. The exam will test this relationship by asking about debits and credits to the balance of payments. Remember that money flowing out of the country is a debit. For example, if a U.S. resident vacations in Japan, that's a debit to the U.S. balance of payments. Conversely, money flowing into the country is a credit. If a foreign company buys U.S. government bonds, that's a credit. The key exam point is that a trade deficit must be offset by a surplus in the capital account. This means that if the U.S. is buying more goods from the world than it's selling, it must be financed by selling assets, like stocks and bonds, to the world. Be prepared for questions that link monetary policy to these international concepts. For instance, if the Federal Reserve raises interest rates, it typically attracts foreign investment, which increases demand for the U.S. dollar and causes it to strengthen. This, in turn, can widen the trade deficit. A common trick question might involve a multi-step analysis where you have to connect a Fed action to its impact on currency values and then to the balance of trade. To keep this straight, use this mnemonic: strong dollar, strong imports. It's a simple phrase to remember that a stronger currency makes it cheaper to import foreign goods, which often leads to a trade deficit. The exam wants to see if you can follow this chain of economic cause and effect. They won't test on complex, nuanced economic realities, but on these direct textbook relationships. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.